The warning signs are no longer signs. They are sirens. They are flashing red lights. They are alarm bells ringing so loud that the only way you could miss them is if you were deliberately covering your ears. And that is exactly what the mainstream financial media wants you to do. Cover your ears. Close your eyes. Trust the system. Believe that everything is fine. But everything is not fine. Everything is very, very far from fine. And by the time the average person realizes what is happening, the window to protect themselves will have already closed. This is your warning. This is your signal. This is your last chance to see what the smart money sees before the opportunity disappears forever. Something happened this week that should have been front-page news on every financial publication on the planet. Something that should have triggered emergency broadcasts and urgent discussions on every business network. Something that reveals the true state of the global banking system in a way that no earnings report, no press release, no carefully crafted statement ever could. Deutsche Bank, one of the largest and most interconnected financial institutions on earth, just sold $89 billion in what they have always called safe assets. Not million, billion. With a B, $89 billion in a single quarter from a single institution. Assets that were supposed to be the foundation of their stability. Assets that regulators required them to hold. Assets that they told shareholders and depositors were untouchable. Gone. Liquidated. Dumped into a market that is only beginning to understand the significance of what just happened. Let me tell you what this bank represents. This is not some regional bank that made bad bets. This is not some startup financial institution that overextended itself. This is Deutsche Bank, a bank with over 150 years of history, a bank that has survived 2 world wars, a bank that weathered hyperinflation that destroyed the German currency, a bank that stood through the collapse of empires, through the Great Depression, through the 2008 financial crisis, through every test that modern finance has thrown at it. And this bank, this survivor of every catastrophe of the past century and a half, just made a move so desperate and so revealing that it tells you everything you need to know about what is coming. They sold their safety net. They liquidated their buffer. They dumped the very assets that were supposed to protect them when everything else fails. And they did it quietly. They buried it in regulatory filings. They used vague corporate language about balance sheet optimization and adapting to market conditions. They hoped nobody would notice. But we noticed. We are watching. And what we are seeing is not a routine portfolio adjustment. What we are seeing is a globally, systemically important bank preparing for something they do not want to discuss publicly. The mainstream financial media gave this story a few paragraphs. A brief mention buried in the back pages, nothing on the evening news, nothing that would alert the average person, nothing that would cause concern among depositors or shareholders. The silence is deafening. The silence is deliberate. The silence is designed to keep you calm while the smart money runs for the exits. Welcome to Finance Currency. I am going to show you exactly what Deutsche Bank did and why they did it. I am going to explain what safe assets actually are and why their sale represents a fundamental crack in the foundation of the global financial system. I am going to walk you through the cascade effect that this sale will trigger across European banks, American banks, and financial institutions around the world. I am going to show you why the window to protect yourself is closing faster than most people realize. And I am going to give you a clear framework for what to do with this information before it is too late. The smart money is moving right now. The institutions are repositioning right now. The question is whether you will recognize the signal and act accordingly, or whether you will trust the same narrative that has been wrong at every critical turning point in modern financial history. They told you the housing market was fine in 2007. They told you the banks were stable in 2008. They told you inflation was transitory in 2021. They told you Silicon Valley Bank was solid in March 2023. They were wrong every single time. And they are wrong now when they tell you that a 150-year-old bank selling $89 billion in safe assets is nothing to worry about. The warning is here. The signal is clear. The window is closing. Let us get into exactly what is happening and what it means for everyone who still has wealth stored in the traditional financial system. Before I show you the full implications of what Deutsche Bank has done, you need to understand what safe assets actually are and why their sale represents such a seismic shift in the financial landscape. Because when most people hear the term safe assets, they think of something boring. They think of government bonds sitting quietly in a portfolio. They think of treasury bills generating modest returns. They think of the stuff that financial advisors recommend when you want stability over growth. But in the modern banking system, safe assets are so much more than boring investments. They are the collateral that holds the entire global financial system together. They are the foundation upon which trillions of dollars in daily transactions are built. They are the lubricant that keeps the machinery of modern finance running smoothly. Without them, the entire system grinds to a halt. Let me explain exactly how this works, because understanding this mechanism is essential to understanding why what Deutsche Bank did is so significant. Every single day, banks around the world lend to each other. They engage in what is called the repurchase agreement market, or repo market. This market moves trillions of dollars every single day. It is the plumbing of the global financial system. It is how banks manage their short-term liquidity needs, It is how the gears of modern finance turn. But here's the critical point. When banks lend to each other in this market, they do not simply trust each other. They demand collateral. They demand that the borrowing bank post assets that can be seized if the loan is not repaid. And the only assets that are universally accepted as collateral in this market are government bonds, treasury bills, sovereign debt, the safest of the safe, the assets that everyone agrees have value, the assets that can be converted to cash instantly in any market condition. This creates what is called the collateral chain. Bank A uses its government bonds as collateral to borrow from Bank B. Bank B then takes those same bonds and uses them as collateral to borrow from Bank C. Bank C uses them to borrow from Bank D, and so on down the line. The same bonds get pledged and repledged multiple times, creating a web of obligations that stretches across the entire global financial system. When this system works, it is invisible. Trillions of dollars flow back and forth every night, and nobody notices. The machinery hums along. The economy functions. But when the collateral starts to disappear, when safe assets are sold and not replaced, the machinery begins to grind. The lubricant drains out. The gears start to seize. This is exactly what Deutsche Bank's sale represents. They did not just reduce their own holdings. They removed $89 billion in collateral from the European financial system. They shortened the collateral chain. They reduced the lubricant that keeps the machinery running. And the effects will ripple outward in ways that most people will not understand until it is too late. Think of it like a game of musical chairs, except the chairs are government bonds. And instead of one chair being removed each round, Deutsche Bank just removed 89 billion chairs all at once. The music is still playing, the banks are still dancing, but there are far fewer chairs than there were last quarter. And when the music stops, when something triggers a scramble for collateral, a lot of institutions are going to find that there is nowhere to sit. Now let me explain why Deutsche Bank specifically is such a critical domino in this system. Deutsche Bank is not just a large bank. It is classified as a globally systemically important bank. This is a designation given by international regulators to institutions whose failure could trigger a worldwide financial crisis. There are only about 30 banks in the world with this designation. Deutsche Bank is one of them. They are interconnected with virtually every major financial institution on the planet through derivatives contracts, lending relationships, counterparty agreements, and the complex web of obligations that define modern finance. When a bank of this size and interconnectedness makes an emergency move, it creates waves that travel across the entire system. Other banks notice, counterparties get nervous, risk managers start running stress tests, the whisper network of institutional finance starts buzzing with concern. Credit default swaps, which measure the market's perception of default risk, start to widen. Insurance costs on the bank's debt start to rise. The smart money starts to quietly reduce exposure. This is happening right now. This is not a prediction about the future. This is a description of the present. Deutsche Bank has made their move, the signal has been sent, and every other major financial institution in the world is watching very carefully and thinking about making the same move before the window closes completely. The collateral is leaving the system, the safe assets are being sold, the foundation is cracking, and the window to position yourself correctly is narrowing with every passing day. Now I need to show you the cascade effect. I need to show you exactly how the sale of safe assets at one bank triggers a chain reaction that threatens the entire system. I need to show you why the window to act is closing faster than most people realize. Because this is not a static situation. This is a dynamic process that accelerates over time. And once the cascade reaches a certain point, the window closes completely, and those who have not acted will be trapped in a system that is restructuring around them. The first domino in this cascade is liquidity stress. When Deutsche Bank sells $89 billion in bonds, someone else has to buy them. That buyer uses cash to make the purchase. That cash now sits on Deutsche Bank's balance sheet instead of circulating through the system. But more importantly, the bonds that Deutsche Bank sold are no longer available to be used as collateral. They have been absorbed by investors who are holding them for yield, not for pledging in the repo market. This creates an immediate tightening of collateral availability across the European banking system. The remaining banks have fewer safe assets to pledge. They have to compete more aggressively for the collateral that remains. This drives up the cost of borrowing in the overnight markets. It makes the entire system more fragile. We saw hints of this stress just last week. The European repo rate spiked unexpectedly. Overnight borrowing costs jumped. The European Central Bank had to quietly intervene to calm the markets. This intervention was not headline news. It was buried in technical reports that only specialists read. But it was a direct consequence of collateral leaving the system. It was the first tremor of the earthquake that is coming. The second domino is mark-to-market contagion. When Deutsche Bank sells $89 billion in bonds, they have to accept the current market price for those bonds. They have to crystallize whatever loss exists between what they paid for those bonds and what the market is willing to pay today. But here is the problem. When a seller of that size hits the market, prices fall. Supply overwhelms demand. And suddenly, every other bank holding similar bonds sees the value of their portfolio decline. This is called mark-to-market contagion. Deutsche Bank's sale does not just crystallize their own losses, it creates losses for everyone else. The bonds sitting on every other bank's balance sheet are now worth less because Deutsche Bank's selling pushed prices down. This triggers a vicious cycle that accelerates over time. Bank A sells, pushing down prices. Bank B sees their portfolio decline in value and decides to sell before it gets worse. Bank B's selling pushes prices down further. Bank C sees the decline and panics and sells. Bank C's selling pushes prices down even more. And on it goes. Each sale creates more losses. Each loss creates more pressure to sell. Each round of selling pushes prices lower and increases the pressure for the next round. We are in the very early stages of this cycle. Deutsche Bank was the first major seller. Others are watching. Others are doing the math. Others are realizing that the longer they wait, the lower prices will be when they finally have to sell. The window to exit at current prices is closing with every institution that joins the selling. The third domino is the confidence spiral. Banking has always been a confidence game. Banks survive as long as depositors believe their money is safe. The moment depositors start to doubt, the moment they start to withdraw, the bank faces existential crisis. This is not theory. This is history. Every bank run in history has followed this pattern. Confidence erodes slowly and then collapses all at once. Deutsche Bank has already had near-death experiences with confidence crises. In 2016, their stock crashed when the market feared they would fail. They survived barely through emergency measures and reassurances from regulators. But confidence once shaken is never fully restored. And when a bank starts selling its safest assets, when they start raising cash for undisclosed purposes, confidence starts to crack again. The institutional clients notice first, the hedge funds, the corporations, the treasury departments of multinational companies. They see the regulatory filings. They see the $89 billion sale. They ask their risk managers whether they should be reducing exposure to Deutsche Bank. Some of them will say yes. Some of them will quietly move their business to other banks. Some of them will reduce their deposits, their trading relationships, their derivative exposures, and if enough of them do it, if the trickle becomes a stream, the confidence spiral begins in earnest. This is how banks die, not with a dramatic announcement, but with a quiet withdrawal of confidence by the smart money. By the time the retail public hears about the problem, it is already too late. The window has closed, the exit is blocked, the smart money has already left. Now I need to zoom out and show you how Deutsche Bank's move fits into the global picture. Because this is not happening in isolation. This is not a problem unique to one bank or one country or one region. This is part of a coordinated worldwide repositioning by the largest financial institutions on the planet. The window that is closing is not just a Deutsche Bank window. It is a systemic window that affects everyone who holds assets in the traditional financial system. In the United States, banks are sitting on over $600 billion in unrealized losses. These are losses that exist but have not been recognized because of accounting rules that allow banks to pretend the losses do not exist as long as they plan to hold the assets to maturity. This is the same fiction that destroyed Silicon Valley Bank. It is the same fiction that is being maintained across the entire American banking system right now. The largest American banks are quietly building cash positions to record levels. They are reducing their bond duration. They are doing the same math that Deutsche Bank did and reaching the same conclusion. The bonds are toxic. Get out while you can. Get out before the window closes. In Japan, the situation is even more extreme. The Bank of Japan has been forced to intervene repeatedly to prevent the government bond market from collapsing completely. The central bank now owns over 50% of all Japanese government bonds because no private investor wants them at current prices. When your central bank has to become the buyer of last resort for your safe assets, those assets are not safe. They are liabilities being propped up by money printing. The window in Japan is not closing. It is already closed. The only thing preventing complete collapse is the central bank's willingness to destroy its own currency to maintain the illusion of stability. In China, the authorities are dealing with their own financial crisis. The property sector is imploding. Banks are hiding bad loans on a scale that dwarfs anything in the Western financial system. And the Chinese have been selling U.S. treasuries to raise dollars, contributing to the pressure on the very assets that Deutsche Bank just dumped. The largest foreign holder of American debt is becoming a seller. This is not a temporary phenomenon. This is a structural shift in the global financial order. In the Middle East, the petrodollar nations are diversifying away from dollar assets. Saudi Arabia is accepting yuan for oil. The Gulf states are building relationships with the BRICS nations. The automatic recycling of oil dollars into treasury bonds that has supported the American financial system for 50 years is unwinding. The buyers who used to absorb unlimited amounts of government debt are becoming sellers or stepping away from the market entirely. Everywhere you look, the traditional holders of safe assets are becoming sellers. The bid is disappearing. The foundation of the global financial system is cracking. Deutsche Bank is not a leader in this movement. They are a follower. They are reacting to forces much larger than any single institution. They are trying to survive a transition that will reshape the global financial order. And they are telling you through their actions that the window to reposition is closing. Now let me prepare you for the pushback. Let me tell you exactly what the mainstream financial media and the banking apologists will say, and let me explain why every single one of their arguments is wrong. They will say this is normal balance sheet management. Wrong. Normal balance sheet management involves modest adjustments, a few billion here or there, rebalancing between asset classes over time. What is not normal is dumping $89 billion in your most liquid assets in a single quarter. That is not optimization. That is liquidation. That is the financial equivalent of selling the family silver because you cannot pay the bills. They will say Deutsche Bank is in a strong position. Wrong. Deutsche Bank has been struggling for years. Their stock is down over 70% from its all-time highs. Their profitability is chronically weak. Their investment banking division has been shrinking. Their credit default swaps have been elevated for months. They are not strong. They are surviving. And this sale is another survival move. They will say government bonds are still safe. Wrong. Government bonds have experienced their worst performance in modern history over the past 3 years. Long-duration treasury holders have lost over 40% of their investment. German bunds have collapsed. Japanese government bonds are only held up by central bank intervention. Safe assets are not safe. They are duration time bombs. They will say there is no contagion risk. Wrong. Contagion has already begun. Other European banks are quietly reducing their bond holdings. The repo market is showing stress. Credit spreads are widening across the banking sector. The contagion is invisible only to those who refuse to look. Do not let them gaslight you. Do not let them convince you that $89 billion in safe asset sales is routine. The signal is clear. The window is closing. The only question is whether you will act before it closes completely. So, what do you do with this information? How do you position yourself when even the biggest banks are running for the exits? How do you protect yourself when the window is closing? Let me give you a clear framework for action. First, recognize that the traditional safe assets are no longer safe. Government bonds, bank deposits, money market funds denominated in fiat currency. These are not the havens they once were. They are liabilities of institutions and governments that are struggling to maintain their credibility. They are assets that have lost 30, 40, 50% of their real value over the past few years. Holding them is a bet that the system will hold together. That is a bet with increasingly unfavorable odds. The smart money is exiting these positions. Deutsche Bank just showed you what they think of safe assets. They dumped $89 billion of them. If the banks do not believe in the safety of safe assets, why should you? Second, diversify into assets that exist outside the traditional system: physical gold, physical silver, commodities that cannot be printed into oblivion, real estate in stable jurisdictions, assets that do not depend on the solvency of banks or the creditworthiness of governments drowning in debt. These are the assets that survive transitions. These are the assets that preserve wealth when the old order crumbles and something new takes its place. History shows that those who hold real assets during financial transitions emerge on the other side with their wealth intact. Those who trust paper promises find those promises broken. Third, reduce your counterparty risk. Every asset you hold through a bank, a broker, or a custodian is exposed to the risk of that institution failing. Physical assets in your possession have no counterparty risk. Diversifying some of your wealth into assets you control directly is prudent in an environment where even the largest banks are showing signs of stress. You do not want to be in a position where your wealth depends on the survival of an institution that is quietly liquidating its balance sheet. Fourth, stay liquid. Cash is trash in the long run because of inflation. But cash is also survival in the short run. Having enough liquidity to weather a crisis, to avoid forced selling, to take advantage of opportunities when others are panicking is essential. Do not be so locked into long-term positions that you cannot adapt to rapidly changing circumstances. The window is closing, but there will be opportunities for those who have the liquidity to act when the panic sets in. Fifth, accelerate your timeline. If you have been planning to reposition your wealth someday has arrived. Deutsche Bank's $89 billion sale is a signal that the smart money is moving now. The window to act before the crowd is narrowing. Every week you wait is a week where the informed money gets further ahead and your options become more limited. Do not let normalcy bias convince you that you have unlimited time. You do not. The window is closing. Let me bring this all together. Deutsche Bank just sold $89 billion in safe assets. That is not a routine transaction. That is not normal portfolio management. That is a globally systemically important bank raising emergency cash by liquidating the foundations of their balance sheet. They did it quietly. They buried it in regulatory filings. They used corporate doublespeak to explain it away. They hoped nobody would notice, but we noticed. And what we noticed is the beginning of an institutional exodus from the assets that the entire financial system has been built upon. The collateral that holds the system together is disappearing. The bonds that were supposed to be risk-free are being sold at losses. The banks that were supposed to be stable are preparing for something they do not want to discuss. This is not a prediction about the future. This is a description of the present. The window is closing. The smart money is exiting. The cascade has begun. The question is what you will do with this information. Will you trust the mainstream narrative that says everything is fine? Will you believe the same institutions that missed 2008, that missed the inflation surge, that missed Silicon Valley Bank, that have been wrong at every critical turning point in modern financial history? Or will you see what is right in front of you? Will you recognize that when a 150-year-old bank dumps $89 billion in safe assets, something has fundamentally changed? The old paradigm is dying. The safe assets are not safe. The banks are not stable. The system that has functioned for 40 years is showing signs of terminal stress. Those who see it early will have time to prepare. Those who see it late will be caught in the flood. I know which side I am on. The question is which side you will choose. This is finance currency. The warning has been delivered. The signal has been sent. The window is closing with every passing day. Like this video. Subscribe to the channel. Turn on notifications so you do not miss what comes next. And share this with everyone who still believes the system is stable. They deserve to know what is really happening. They deserve to have the same chance to act that you have right now. The window is closing. Do not wait until it is too late.